Hello, good evening, everybody, and welcome to Market Analysis Live for Sunday, December the 28th. This is George from TRADEPRO Academy, and this is our very last webinar of 2014. And then next Sunday, we move into the first one of the new year. So two exciting webinars here. And as the last webinar of an entire year, this webinar is going to be focused solely on going back through, looking what our predictions were in 2014, or at the end of 2013, what we said was going to happen in 2014, and seeing whether it did actually happen. So this is a follow-up review webinar, and then we're going to get into the most exciting part of the year, doing a 2015 forecast and where we think asset prices are heading in the coming year. It's going to be gold, we're going to talk about oil, equity markets, the US dollar yields, and then we're going to go in and look at that on a weekly analysis and break down on the daily as well, and we'll cap it off there. All right, so tonight we're going to look at our performance. How have we done in 2014 in terms of dollars, in terms of percentages, and in terms of predictions. And then we're going to carry that through to 2015 and project on what might take place in the market in 2015. I do caution you that projections, guys, are more so fun and guesswork than they are the bottom line of what we do as traders, all right? Because whether we're right in the prediction or not for an entire fiscal year does not matter. The real thing, the real determinant of how we've done as traders is the profit. How have we done with our win percentage, our losses, our profits, and our money management, and that's the most golden part of it. So let's have some fun, but let's not forget that even if you're wrong in a prediction, you can still be profitable, and that's the beauty of our industry and what we do. All right, so how are you guys feeling tonight? How is everyone doing coast to coast, nation to nation, out there in Market Analysis Live viewership? Here, let me open up the... All right, perfect. Everyone's doing fantastic, which makes me feel even better. All right, so you might notice a little bit of a different format on these slides to end the year. So for December 28th of 2014, I have to remind you that the information in tonight's presentation is for educational purposes and is not meant to be taken as investment advice. What you do is up to you. You're responsible for your results, but at the same time, you're also responsible for your own profit. So that's the beautiful part of it. All right, so let's get things kicked off here with a year in review for 2014. All right, so how was 2014 to us as traders? And when we say a year review, we're not going to talk about our predictions for 2014 and that we did in 2013, but in terms of profit. All right, so one of the key things I wanted to look at for that gauge or determination for 2014 was our Market Analysis Live results. For those of you out there that are new or listening to our webinar tonight, this one's open and free to everyone in the entire world. We'll be posting this all across blogs and social media as a freebie to you. For those of you that aren't familiar, the way this works, we go through every Sunday, we identify trading opportunities, we follow through with them, we move stop losses, and we lock profits, and this is how our account has done, all right? In the past 12 months, all right, so this fiscal year, so all of 2014, we've generated about $85,000 in profit, all right? For those of you that have been around since day one with Market Analysis Live, you'll remember that we started June 17th of 2013. All right, that's the official and the very first webinar that we had for TRADEPRO Academy, and we started it with $50,000. And today we're a little over $150,000. So we've tripled our money since then. And in 2014 alone, we brought in $85,000 of profit. Now, I know we were up to 100 just a couple weeks ago, and those were sweet and joyous times. But you have to remember, there's ups and there's downs in your equity curve. And while this is a down, the most thing to really consider here is it's from the bottom left to the top right. All right, look at that. At one point we had 100K. We're closing out the year with about $85,000 in profit in our trading account. And our moving average here, which is the blue line, has just consistently been going up. All right, so if remember traditional technical analysis, this is actually a support level. So you can expect this account equity to increase in the coming weeks. All right, so there you go. Those are phenomenal results for 2014. We look forward to carrying that momentum through to next year and have absolutely no expectation to have any kind of less prognosis. We're going to be going for more, going for gold in 2015. All right, from a statistical analysis, total net profit in the year was $85,237. We won 65% of our trades, which is a phenomenal achievement. However, I always tell you guys time in and time again that the winning rate is not the important part. The more important part is money management, and when you actually win, how much do you win, and when you lose, how much do you lose, and what's the ratio of that? That's more important. However, take note, you win 65% of the trades you take through Market Analysis Live. All right, looking at our other statistics, so total winning trades in terms of a number of 59 winners, 31 losers, which means in the last year we've done 90 trades. All right, a lot of people say, oh, well, you trade. How do you have time to put 100 trades a day? And I say, I don't. I don't have time and I don't do it because it's roughly about 90 to 100 trades a year that we place, which means every month you're doing about 10 trades, which means every week you're doing 2 to 3 trades, which means you don't have to be doing this 9 to 5. All right, that's the beauty of the way we trade. So therefore, 90 trades is the total we've done this year, and we've won 59 of them, or 65%. The other interesting statistic is the average win. Remember, just recently I said it doesn't matter how many percentage of the trades you win, it all matters about the dollars. All right, you can't go and pay for a vacation out of your 65% winning ratio. You can't say, oh, here's 3% winning ratio, book me 2 first-class tickets to the Bahamas. It doesn't work that way. You pay with dollars. And our average win in dollars was $2,087 for each single trade that we placed. Our average loss was $1,222. So what does that mean? We win roughly 2 times as much money for every winning trade as we lose. All right, so if we win $2 for every dollar that we lose and we win 65% of the time, then you guys start to see how we build something that looks similar to this, our equity curve. All right, it's not rocket science. It's all about predictability. It's about momentum and it's about expectation. All right, if you look at somebody's results and they made $100,000 one month and lost 80 the next month, those swings and fluctuations represent volatility and risk to you, to your lifestyle, and to your career in trading. So that's really the exciting part of these results, is that we've done this consistently, we've done it profitably, and we've done it over and over again in Market Analysis Live. So great opportunity for those of you that aren't members yet to sign up and try it out. You get your very first month for absolutely free. That's 4 webinars, 90 minutes each on Sundays at 8 p.m. Eastern Time. All right, so I hope you guys join us. Click the link on the video if there is a link to the video you're watching. If not, always feel free to sign up at TradeProAcademy.com. You get your first month on the house. All right, the other thing I wanted to show you here is our largest win was $15,000. Our largest win single-handedly was more than 15% of our annual gain, which is great. And look at this, our average loss, 1/3 of that. So even the extremes, we're winning more than we're losing, which is a phenomenal statistic. And the last one I want to share with you is average number of consecutive wins, 3.11. Average number of consecutive losses, 1.63. So when we get on hot streaks, even our hot streaks are better towards the winning trades than losing trades. Our hot streaks are hotter than our cold streaks are cold, if that makes any sense to you. Obviously, Trade Navigator doesn't report that statistic, but that's what it tells you right here. The other one I wanted to spend with you is the average number of bars and wins, and it's not reporting for some reason, but trust me, it's good. All right, current streak, however, we're on 3 losses, so we're on a bit of a cold streak. That doesn't really scare us at all because we've returned an average of 77% of our account balance in a year. What do you get in a GIC? What do you get in a guaranteed deposit? What do you get from your bank account? What, 2% maximum? We've done 77% in the past fiscal year in 2014. We stand behind those gains and we look forward to doing it again this year, 2015. All right, no problem. Freddie, did you get the gift? We also sent you guys your gifts last week. Hopefully you're enjoying them. For those of you that haven't got them yet, I won't spoil the surprise, but they're motivational, and they'll be there with you every day that you trade. You hold it close, and they'll energize you. And I'm not going to give any more hints because I don't want to spoil it. Okay, perfect. Glad you got it. Enjoy it. And happy holidays to all of you. All right, so there you go. We've done fantastic. We've had a good year. We've had a good run, guys. But at the end of the day, as traders, unfortunately, you're only as good as your last trade. So who cares what I've done today? What are we going to do tomorrow? That's the most important part. All right, since inception of Market Analysis Live, we made $105,000 in total of 120 trades. We've won just under 70% of our trades. And for every gain, again, our average win 1,700 versus our average loss. And we've had 83 winning trades. Okay, so things are good. Things are going well since inception. Remember, inception is June 7th of 2013. That's when Market Analysis Live started officially. That's when we're tracking our trade results. Okay, 2014, we went out on a limb and we made some predictions in 2014, didn't we? We said a few things were going to happen. tonight I want to share with you our scorecard. All right, in 2014, actually in 2013 in December, we went in and did exact similar webinar to this, to what you're hearing today, and we said, let's look at all the asset classes, let's make a prediction out there based on technical analysis, based on economics, and based on what we know as traders, and let's see how we stack up. And today we get to close the loop on that, and I'll tell you how we stack up pretty good. All right, equities. We went out there and said they're going to be moderately bullish. On the equity front, our 2014 prediction said there might be some turbulence, there might be some sideways action, but overall, because there's a trend and the trend is bullish, and as technical analysts, we're trained to follow the trend, we said we got to go bullish on this. We got to be bullish with some expectation for some potential downside or correction, but overall we're bullish. What ended up happening? The market came in very bullish for 2014, had a fantastic year. And the only reason they give us a grade B instead of an A+ or an A is because we said moderately instead of very bullish. All right, so I'm being fair here and grading myself. Give that a B. We weren't as bullish as the market was, but I mean our results speak for themselves. All right, US dollar, we said we were going to be bullish. In the webinar, we said US dollar, I can see it nothing else. I can see it doing nothing else but appreciating in 2014. What did it do? It appreciated in 2014. It sure did. So we get an A+ on that on our scorecard. Yield rates that we talked about measured by TNX, which is the ETF, we said we're going to have lower yields while the market goes up, and we also said that that was going to be a bad thing overall for the economy. All right, what happened? The yield rates went down and the market went up, and we said that's not a good thing. So for being able to say that that's not a good thing and saying that that's in fact a bad thing, we have a good rating. So there's an A+. We're right on that prediction. Gold. In gold, interestingly enough, what we said was going to happen, we said the market was going to go sideways, put an E in there, and we're going to see some sideways movements in gold, and what ended up happening was exactly that. It rallied quickly, it dropped a little bit, it bounced around, and it ended the year pretty much right where it started it. Okay, so sideways, spot on, check mark, another A+. Trading results, we said our goal was to double our account. We missed the mark slightly, as you saw. We made 77% return, and you know what? We'll take that. That's good. We'll give that an A overall. So satisfaction was one that we consistently measure ourselves on. In terms of the trades, in terms of the product, yes, I work hard to design that. We work hard to make sure it's consistent and it's good and it meets your demands. But satisfaction is the most important to you guys. And based on our score of this year, I can tell you 100% satisfaction. We had all of our users that took the foundations course extremely satisfied, and a lot of the market analysis live users as well. All right, we have a money back guarantee. If you try the product and you don't like it, and you can tell us what you don't like about it, you get your money back. All right, and we stand by that. So grade A+, overall rating, we got an A on our scorecard. All right, so good job. I can show this one to my parents and say, hey, look, I got an A. This is a report card I'll be bringing home and not one that I'll be pretending to lose. All right, so good job to all of you, not just to us, but to you as well. You've been part of this entire ride. Okay, and that's how it's looked. Before we get into our 2015 predictions, I just want to ask you guys how you're doing, if you have any questions so far, and comments. And if you want to actually go through and look at these predictions, why don't we do that actually? Why don't we do that? So we said on the yield front that in 2014 we expected the yield rates to go down. So let me switch to our scratch pad here, and we're going to look through each and every one of these and see what actually happened in 2014 and why. Okay, so let me just close these down, clear my workspace here a little bit. TNX was the 10-year treasury note, and here's what happened. So in December we said, hey guys, we think the yield rates are going to start going down, interest rates to remain low. And sure enough, the last couple weeks went up, but from day one, from January, the first trading day of January, I'm not sure if it was the first, until today, the yield rates were down. They're getting plowed, all right? So it was about 3% yield, and now today's market, we're about 2.18, all right? So down 80 basis points. That's huge. And why is that big news? Because TNX, as a representation of a yield rate, measures what? What does it measure, guys? Borrowing costs. All right, borrowing costs. And why is that a bad thing for interest rates to be going up? Well, right now, actually in 2014, it was a good thing. All right, borrowing costs dropped. So more people are able to afford mortgages. All right, less payments for debt means you have more cash flow. However, lower interest rates tend to punish the savers. If you have $1 million stored in cash and you don't know what to do with it and you don't want to trade it, what you're earning on it is the interest rate. So if your interest rate's low and you have a whole bunch of cash that you've been hoarding and saving, well, guess what? This environment for you is terrible. You can't wait for interest rates to go up. Now, if you're a borrower with $1 million mortgage, all right, you don't want the interest rate to go up. You want the interest rate to stay down. So 2014 favored the market of borrowers and not the savers. And the great news is, although sad, in the U.S., don't worry. There ain't that much savers anyway. The majority are borrowers. Therefore, these yield rates are actually a positive thing in the marketplace. They drove a lot of lending. They drove a lot of new credit and expansion in really purchasing power. More cash flow, less money spent on debt, more money you have to purchase other goods, services, and commodities. All right, so that's what happened in 2014 on the yield rate front. And who do you guys think is the biggest borrower out there? Who else do you think is extremely happy in the United States that the yield rate is low? It's the government. All right, because if you have $14 trillion in debt, calculate what a 0.80% interest increase will lead to in terms of your debt payments. Go ahead and calculate it. It's mind-blowing. It's mind-numbing, actually. That's why they wouldn't want the interest rate to go up. That's why fears of interest rates rising are actually going to potentially punish the equity markets. And we're going to talk about that a little bit more. So why don't we do this? Why don't we say here's what happened in 2014 for the yield rate. Let's see what our forecast is for 2015, and then we'll move through all of our asset classes. So in 2015, what do we predict for the yield rate? Well, here's what our prediction is officially. We think the yields are going to pump back up to this $3% rather, front. All right, so interest rates are going to go up to the 3% on the yield, and interest rates as well, by the way, are going to rise. That's our prediction. Why? That's what Janet Yellen tells us. That's what the Federal Reserve has been preaching. They said from Q2 of fiscal 15, we expect to start raising interest rates even in small amounts. All right, that will increase yields. As yields go up, what else is going to happen? Long-term bonds are going to drop. All right, they're going to drop like a stone, like a rock in the water. They're going to go down. Why? If you have a bond for $1,000 that's paying you, let's say, 2% coupon, and these are regular intervals of interest payments on a monthly basis, 2% annualized, what happens if the market rate suddenly goes up to 3%? Well, you're not going to buy this 2% bond for $1,000. It might be worth $900, let's say. That's why the price of bonds is directly and inversely correlated rather to the interest rate. So when interest rates go up, bonds are going to go down. Markets are also going to get hammered. People who have debt today, it's going to reset. It's going to start going up. Their mortgage rates are going to start to climb and escalate. Their payments are going to go up. All right, a lot of inflation and indexing. Inflation is actually not tied to this, but a lot of indexing is dependent on these bond yield rates, and the government's going to end up paying more money for their debts. There's going to be less cash flow. It gets interesting. Okay, it gets interesting. So we're going to see when interest rates go up and when yields increase, how much of the market was real momentum and how much of it was pumped up by the Federal Reserve. Because when interest rates go up to 3% as we forecast, we think the markets are going to head lower. All right, that's going to be real pressure put on the markets. Can they sustain it? That's what we're going to see in 2015. All right, so our personal on-the-record prediction here is yield rates up to 3%, not interest rates, yield rates up to 3%. And the Federal Reserve is going to raise the rates somewhere mid-year. Towards the end, they're going to say, whoops, we raised it too much. We don't think the market's ready. And we're going to be talking about stimulus in December of 2014. Mark my words, we're going to talk about another round of stimulus. That's just my prediction. It's on the record. All right, next thing we wanted to look at is go to the equity market overall. For the equity market, we use S&P 500, SPX to measure it. So let's get in there. Let's talk about what we said in 2014. All right, and in 2014, our predictions were as follows. All right, in the market front, we said that we were seeing a moderately bullish trend for 2014. All right, remember this happens to be in December, so it's right in through here. So you know what, we're going to see a moderately bullish market. Why? Because the trend was up until then, and the trend is our friend. We're trend traders as technical analysts. We don't fight the trend, we jump on board. But we said, you know what, in the short term, we can foresee a drop in the market taking place. And sure enough, in the first month, we were right. All right, we were right, and we believed it was going to stay in between here and be up a couple hundred points, but not make too much progress. However, what actually ended up happening was a massive rally to new all-time highs, and after a huge drop in October that we called pretty much on the dot. I don't know if you guys remember, but we did our market analysis live, and we said there's going to be a correction, there's going to be a sell-off, and then this happened. Okay, so we called this. It's exactly what we said. Remember, it was based on double top, broke of neckline, channel resistance, a whole lot of different variables were factored in here. All right, so you guys were there when we called that. In fact, we even took some trades to the bearish side when this recent sell-off happened to pretty much end the year in the market. Now, on the S&P 500, when we said we're going to get a 2014 that was positive, we were right. And there it is. It happened. Okay, that's why on the scorecard we gave ourselves a good grade, because we pretty much called that trend. Now, in 2015, I will say this, 2015 is going to be a much more volatile and difficult year for buy and hold investors. All right, for the guys that are in there that want to buy and hold for the long term, they're going to see a little bit more volatility, a little bit more cycles to the upside and downside, a little less sleep through 2015, and a little more fear out there in the markets, more uncertainty. That's what the prediction for 2015 is. From a technical standpoint, what does that look like? Well, if we switch on the monthly and zoom in here, what we can see is every time we've hit this resistance, we've dropped, and ever since 2011 here at the end of the year until right now, we've been going and humming along to the top of this channel resistance. All right, notably of this last month, we're getting this pattern taking place, which looks like this, which is a hanging man at resistance on decent volume. So what we're saying here for 2015, it's going to be a choppier ride. There'll be more volatility. All right, guys, which is good for traders, but a brutal thing for investors. Okay, because no matter what they tell you, even though they have a long-term horizon, volatility in the short term worries everybody. So in 2015, calling yourself a trader and saying, hey, I'm making money as the market drops, I warn you, on the record, you may not have as many friends as you did in 2014, because traders and investors were profiting together. 2015 will be the biggest test for us. Now, I do believe we're going to get some kind of 10% correction at some point, and I think that 10% correction will coincide with when the Federal Reserve officially announces they're going to be raising interest rates. Okay, and you saw that because Bullard, which is one of the Federal Reserve members, came out there and said, hey, guess what, guys, we're going to be relaxing, or even though we've wound down our quantitative easing, interest rates are going to start going up soon. However, we're going to be a little bit more accommodative, and we're going to be a little bit more patient. Remember? And then Janet Yellen echoed the exact same word, patience, and then that patience said, phew, we're going to have support for longer than we expected back into 2015, and the market rocketed off the lows. All right, that's why we got this looking candle here. We had some lows. We had the Federal Reserve come in and save the market. All right, and the Fed has saved the market for a couple of years now. Let's see what happens when they take the training wheels off and raise interest rates. 2015 equity markets, we're going to go sideways to moderately bearish to get some retracement. All right, does that mean the market can't do this? 1 second. Does that mean the market can't do this and just skyrocket higher? No. But if it does, we'll keep you posted on Market Analysis Live, and we'll even make some trades to the upside. For the time being, we see a rocky ride in 2015, especially when the Federal Reserve moves to move interest rates. Okay, but that being said, trends up. We're at a resistance. We're just expecting a retracement to a bullish trend. So we remain bullish on equities, but we see some turbulence in the deck of cards. Okay, let's look at another asset class. Any questions so far, by the way, from you guys? All right, let's talk about the US dollar in 2014 and what we've done. So if you go on DX, that's the US dollar. Here's a monthly chart. Let's go weekly. so we could see it a little bit better. What do we say in 2014, guys? What was our prediction? Well, I'll tell you what it was for the US dollar. We had talked about an increase in 2014. We said, listen, if there's any fear in the marketplace and the equity markets overall that there's going to be some kind of correction, if there's any political instability, and boy, did we have political instability in 2013 across the globe. We had crises of all nature, shapes and sizes. We said the US dollar is going to rally. All right, at the first sight of any kind of uncertainty, at the first smell of fear, the US dollar was going to go up. Through the first half of the year, it remained pretty stationary, but from 2014 around May all the way up to the end, it's done nothing but skyrocket. It's gone from 80 to 90 on the US dollar index. All right, and these are the future prices for the US dollar index, which is a US dollar versus 6 other currencies. Now, we said this also tends to move inversely with equity markets. All right, and the stimulus tapering that the Federal Reserve announced they were going to do, they said we're going to cut down our $85 billion a month, and we're going to cut it down by $10 billion and eventually eliminate it by October of 2014. That they did. And as they started doing that, the dollar went up. Why? Well, because buying $85 billion a month of bonds means that they take the bonds in their book or add it on to their balance sheet, all right, and in exchange pay cash. So through the process of buying bonds and paying cash, they're actually providing liquidity to the market. Providing liquidity in the form of cash increases supply. Increased supply in the market means your dollar gets debased. It gets devalued. It loses purchasing power. When they announce they're going to tighten that and say from 85 to 75 to 65 to eventually 0, which was the tapering process, the currency immediately started to go up. And that expectation was built in their analysis for 2014 and 2013. So sure enough, that's happened. What about 2015? What does that look like? Again, it's going to be a bit more of a turbulent cycle for that US dollar. All right. Strong dollar usually puts bearish pressure on the markets, and it's usually inversely correlated. Remember, we talked about that last year as well. We said as the dollar goes up, markets tend to go down. Has that happened recently? Well, you'll be surprised. I'll show you. Let's go SPX, S&P 500 for the equity market. The answer to that is no. So while the market's gone up, the dollar's increased as well, and that actually is a great thing. That's a good thing. Okay, and that won't stay for too long. They'll deviate in some nature, and the belief here is the market will go down while the dollar continues to go up. Okay, so US dollar up, equity market EQ down. That's our expectation to start 2015. The one thing we do have in our sales that keeps us a little bit bullish is that this is a pre-presidential election year, and in all pre-presidential election years, they've been bullish. Actually, 14 out of 16 pre-presidential election years have had a positive market return. Okay, so it's been bullish. Now, that doesn't mean that we can't have a couple months of downside to recover and end the year strong. So remember, there's two things we're talking about here: annual gains or losses versus short-term fluctuations. Short-term fluctuation, we believe equity market's going to start off with some weakness. There's going to be a correction at some point, but for the overall year, pre-presidential election years tend to be up. So we might have a slight gain. And again, that reinforces the message, it might be a volatile environment. So get ready for that in the coming year. All right, dollar index for 2015. We think it's going to continue to go up as the market goes down. That's our prediction. Not at this pace, obviously, because at this pace, by end of 2015, it'll be at the moon. And that's not going to happen. So there's our dollar index prognosis. 2015 is going to be bullish, as 2014 has been. Any questions so far? We're going to look at two more: gold and oil. Okay, because last year we had a gold. Last year we had ourselves a gold analysis. We talked about gold overall, so let's have a look at that. I'm just checking one thing here. Oh, by the way, our target for 2015, let me delete the SPX here, on the dollar front is 101.70. So we think we're going to make that run in 2015 here to coincide or start playing with the levels, flirt with the levels from 98, 99, and 2003. Okay, so we see a strong dollar. The strong dollar hurts the exporters. Why? Because their goods are suddenly more expensive in the global competition, in the global markets. But it helps importers bring in goods at a more favorable rate, right? Because as your US dollar price increases, because the United States enjoys the privilege of being the reserve currency, they enjoy the fringe benefits of more negotiation, better import prices, but it hurts their exports. Good thing they're not a predominantly export nation, right? GDP is going to be flat this year. Based on that, that's our belief. We're going to see some flattening GDP. And the number one key concern for us in 2015 overall is the J word, jobs, and the E word, employment. All right, and that's what we're looking at from the economic standpoint. The economist in me says I want to see better jobs, better employment for me to be satisfied of this recovery. And I think 2015 will be a much tougher market to live through than 2014. Okay, 2014 went down as everything you bought went up in prices. But also 2014 is going to go down in history as the year that an extraordinary measure of flooding the market with money was ended. That experimentation period is over. As of 2014, the Fed went from $800 billion to $4 trillion of quantitative easing on their balance sheet. Okay, so now the question becomes, all right, market, the training wheels are off. It's January of 2015. Go. Let's see what you're made of. That's the motto for 2015. All right, there's a dollar. We talked about imports, exports, GDP. We talked about a whole pile of stuff. Are you guys all right with this stuff so far? I'm surprised there's no questions. I would think from this you would have some kind of questions, but nobody does. So let's go back to our gold. Okay, in 2014, what did we say about GLD or gold? Well, here's what we said. We said the following will happen with gold in 2014. We said, you know what? If markets turn to fear mode, so there's always two modes in the market. You guys know this, the F and the G. There's fear and then there's greed. When there's greed, assets like equities go up. When there's fear, safe haven assets like gold and the US dollar tend to do decent. And we said if there's fear in the markets, gold will go up. All right, it'll increase. We also saw in 2014 here potential inverse head and shoulders that could have taken off in the early years. So we said here's an inverse head and shoulders, double bottom here as the head. Okay, so right here, double bottom, and then here's a shoulder, shoulder, and a head. This head was made of a double bottom. We said if this neckline's broken, gold's going to make a run. All right, in February, this neckline was broken, gold made a run. So we looked genius on that front. And then, however, we said, you know what, overall, we think gold's going to be flat. It looks like a bottom. There might be a trade here in gold, but in the year, based on the economy, based on supply and demand, gold's going to end the year flat. Well, look at this. You can't make this stuff up. As of pretty much yesterday, what was the open price here on gold on January 2nd, open 1204. On the close of December, we still have 3 more days. Remember, December 26, 1194. Okay, so $12 per ounce in the year. That's absolutely inconsequential, and it pretty much went flat like we thought it would. Save for this trade here that popped, you got some profit, then they came back, and now it's flat. So gold, that's where it's at. What about 2015? All right, we called the trading range of 2014. What do you guys think is going to happen in 2015 on gold? Does anyone have any predictions of their own they want to make? Well, again, I'm going to rehash this because we talked about it before. If we tend to have a period in the markets where people are scared of everything, they start to lose confidence in the economy, interest rates start to go up, the market starts dropping, we will see gold increase in value. Okay, and that's just based on a reactionary measure, because whenever there's doubt in the economy, whenever there's doubt in the fear model of investing, people tend to go the traditional safe routes like gold because they tend to see it as a currency. A lot of people say gold is the international currency and the first measure that was used for purchases, the first monetary system. The first thing that was called money was gold. and people tend to flock back to that. Now in 2013, at this time, I asked you a question, I'll ask it again. In a time of a true absolute Armageddon situation, who will win? A person with gold or a person with a shotgun? 2013, you answered person with a shotgun, obviously. 2014, that doesn't change. All right, that's the problem with gold. You got to be careful. It has absolutely no utility. Other than jewelry, what is gold good for? All right, if you come to me with a piece of gold or a loaf of bread and I'm dying of hunger, no offense, I don't want your gold. I don't eat it. I can't eat it. My body won't digest it. That's the problem. So anyways, if the markets go down, gold will experience a shock to the upside. It'll rally. But we're going to say that the price of gold, our official analysis here on the price of gold is going to be, it's going to rally off this bottom that we've seen. It's going to continue to go up. During this 10% correction of the equity markets, that's when we're going to see gold go back up to probably around 1350 to potentially 1400 here an ounce. So end this little gap. That's where we see gold ending 2015. So we're going to see an appreciation in the price of the gold metal. All right, and that's going to be the 2013 resistance point. Let me just zoom out a little bit to show you this. So it's here. These are the tops that we're kind of targeting. This is the prediction area that we think gold's going to end up at, which will be a resistance all the way up to 2013, and one that we faced in the rally in 2014 as well. So 1, 2, we think we're going to see a number 3 in 2015, the price of gold. All right, we're not going to see a rally like this. We're not going to see a drop like this. We're going to see smaller, more gradual movements in the upcoming year. All right, price-wise, 1350. That's our call for gold. Now let's look at oil and end it there, because this is our prediction segment. We did a 2014 review. Let's end all of this off with oil, because oil's had a dramatic year. All right, look at that. Let me show you a monthly chart of oil. Holy smokes. Let me ask you guys a question. How does this make you feel when you look at this chart? What's the first emotion that you get? Be honest with me. What's the first emotion that you get when you see this, if any? Maybe you don't experience emotions. Fearful, some people said. Ooh, somebody used the O word, opportunity. So you feel opportunistic when you see this? Guess what? That's how I feel too. Scary might be a word. But remember, guys, for every movement, what if you had puts? What if you bought puts on this? All right, so this is what I'm saying. All we need is movement as traders. We don't care in which direction. Our technical analysis will help us spot that. So yeah, some people are scared, some people are worried, some people are fearful, others see opportunity in this, and there's a lot of opportunity in oil. So this massive drop, Saudi Arabia came out there and said, well, we're ready to see oil at 10, 20, and $30 a barrel. I'm going to tell you this right now, that's not going to happen. It's not going to happen. All right, a lot of jobs will be lost if that happens. It's already taking place now in the economy. And cheap oil, as much as you might think is helping you, is actually hurting you. I don't care where you live, what you do. A lot of our industry is based on oil. Cheap oil in the long run is not good. All right, it's not a good thing. Jobs will be lost if this continues. All right, so this sell-off here in the past 4 months that's taken place in oil takes us back to 2007 lows. I'm going to go on the record and say that may be a bottom for oil price. We may have an opportunity to play the upside. All right, in fact, 2015, the price of oil is one of the things that excites me and gives me the biggest opportunities in our trading accounts. We're going to trade this. Okay, we're going to add this to our list of Market Analysis Live, and we're going to trade oil on the upside. Where do I think it's going to go in 2015 in terms of the actual price? Well, it's oversold right now. That shouldn't be a surprise to anybody. And I'd probably see, let me actually switch to a weekly chart on this. If it starts bottoming out here, I could see oil ending back up at the $84 a barrel range. All right, so off the $55 lows. And once it gets there, all right, if we want to do some Fibonacci analysis, we could easily find a target of retracement. So let's say, look at that. 84 to 87 is probably where it's going to end up at, because that's a 61.8 full retracement. And then once it does that, it's just going to go there in one of those sleepy modes that oil does in a 5 to 6 narrow dollar range and stay there for the year, right? That's just the forecast. It looks like this thing's bottoming out. When you look at momentum indicators, even on a daily, if you look at it on a weekly, if you look at it on a monthly, no matter where you look at it, this guy is oversold on oil. All right, and if oil continues to go lower, it's going to put a lot of economic pressure, and it's going to put pressure on the overall markets. All right, it's going to put pressure on corporate profits. All right, it's going to put pressure on employment. It's going to put pressure on the Federal Reserve not to raise interest rates, to keep them flat, and it's going to cause a lot of problems out there in the marketplace if oil continues to go lower. I don't think cheap oil is a good thing. We'll see this thing rebound. I think it's overdone, and I mean, there's a lot of different theories as to why it went down in the first place. I think it's a political battle, first and foremost, than it is more of a supply and demand thing. Because look at it this way. When the price was $1.30, or when now it's 96 cents per liter, not per gallon, do you drive any less or more? Well, you drive at the minimum what you need to survive, to buy groceries, to go to work, and maybe you drive more now for leisure. But at the end of the day, you're still going to buy oil, whether it's 96 cents, $2, or $3. The question is, how much do you drive? Okay, so it's not a demand issue. It's a supply issue and a political thing as well. That's what's driving oil lower. We're not going to get into it. It's a hairy situation, but we're going to call it a bottom at some point here in the next couple months. Not yet officially, but that's what we see happening. In 2015, we see a rebound in oil up to $85 to $87 to end the year. All right, any questions on oil? So we looked at our scorecard for 2014. We got an A. Let's see what we do in 2015. I guess the uncertain part of this is we have to wait 12 months to find out of our scorecard. We've had a great 2014. We look forward to a strong 2015 as well, and that's really what we see taking place and taking shape. How we trade, that's not really deciphered, or really that momentum's not built based on what we think overall that large scale of a term. 2015 overall is not going to dictate how I trade the next couple weeks. All right, let's not get that confused and complicated there. But what we're saying is, here's what we see happening in 2015. Our trades are going to vary, and I'm going to tell you this: the profit's going to go up. I'm certain our profit's going to go up no matter where the markets go. We might see a little bit more of headwind, more challenge, but the profits are still there, and we're going to take them off the table, and that's our commitment to you at TradePro Academy. All right, any questions on the forecast here of 2014 results, 2015 forecasts, and where we think these things are going? All right, we're also getting some growth taking place TradePro Academy. So as you guys know, the Foundations course is going to see a few changes. It's going to be revamped. You have unlimited retakes if you paid for it before. Remember that. We also have the options course. It's underway. Not making progress as much as I'd like, but it's underway. We also have changes to Market Analysis Live that'll be phased into 3 stages. So a lot of changes happening for you guys. You'll also see that as well in 2015. A lot more growth on the business front of it. Okay, let me see who's in here, how many people we got, what the situation is. And what we're going to do next is very quickly go through our trades and look at them on a macro level like we've done with gold and silver. We're not going to have any trades this week. I'm being upfront and honest about that. I don't want to get into a situation where I'm trading in a low liquidity market, low volume. And that's what's going to happen because Thursday, January the 1st is a holiday. The 2nd of January, which is a Friday, which is a second trading day, it's also going to be thin volume. And the first 3 days, who knows what's going to happen to end the year, all right? Because tax loss selling is officially upon us of the 26th. As of the 26th, that was the last day that you could actually go out there and initiate some tax loss selling positions. That's already over and done with. And honestly, this is probably the last week of the holiday. You won't see much volume or activity. Okay, so we're going to not do any individual trades, but we'll look at each one of our stocks individually for analysis. So let's get started. We'll be changing this list as well, by the way. I'm going to be taking out a few stocks and replacing them on our official list. Well, I'll keep you posted on that also. All right, Apple. Let's get started with our good old friend Apple. And let's talk about what's happened in 2014. All right, in 2014, had a very interesting year. We went with an ascending triangle that broke. We went to an extension. We had a little sell-off here taking place as well. And now we're starting to look at some triangle-like behavior in Apple. All right, we did a split, a 7-to-1 split that took place. The price dropped. It rallied, it now dropped, and it's trying to go bullish again, but volume's weakening. So for 2015 and above, we see Apple as a bullish thing. We see it going higher, but we first see a potential retracement coming into the deck of cards here, which might actually end up looking like a head and shoulders out into, here, let's go daily. Head and shoulders that might be forming here that might take us out into March or April before we start going up and we find support of this line. All right, so at the macro level, Apple's looking good. It has upside, but right now it's consolidating. Let's look at Amazon. All right, Amazon, what has it done in 2014, which is this year right here? It's had a bearish year. All right, in January it was $400. Today it's $300. It's lost $100 or 25% of its value in a year. All right, now in Amazon, we see ample opportunity in 2015, not based on fundamentals, because as you know, we're technicians. We really behave based on technical analysis. So the biggest opportunity for us is that it's both at a support level in a key horizontal line, okay, and it's also at a support level from a key trend line, which is upward sloping. So it's bullish no matter how you look at it. Even though we've had lower highs, the lows are all equal, which means we're getting buyers that are interested at the 284 level that are propping this up. And once we start seeing some volume, 324 being taken out and 343 eventually, we're going to jump on this. And for 2015, we're going to ride Amazon, hopefully to some profitability. Here's what I see it doing in 2015. If it continues on this pace and this trend line, maybe right through here, so price potentially going up in this nature, another run up that we've seen here, we could probably see it take out the $400 level, so probably around 425 or 415 approximately for 2015 based on technicals. Okay, so we said, why aren't we looking at indicators? Well, because indicators are very cyclical and they tell you on the inner cycles of a big trend, of a massive grand scale trend, to look at the small tidbits. And we're not looking at the small tidbits today. That's why we're not really going through the indicators. We're looking at this from a price analysis point. For those of you that like Elliott wave analysis, that's an opportunity for you to do some of it as well. Look at this. So you can do 1, 2, 3, 4, 5, A, B, C retracement. Okay, so wave number 1, we could be ready for that as well on Amazon. So I really like Amazon. We're going to keep trading it. We're nothing but bullish on it. All right, American Express, a company that's really handed it to us in 2014. I remember this little peak saying, all right, time to short, didn't work out. All right, time to short, buy puts, we got stopped out, and then we missed a massive drop that we're calling. Okay, so AXP is all about timing. You got to be patient. You got to add to your positions and not get carried away. All right, what do we see for it in 2015? This one's a little bit harder to work with for the following reason. We just came off of a low here that we've rallied up, and we're in the middle of a channel. Okay, so two things can happen. One, we can fail at this $95 resistance and head back at support, or we could break out and go for the resistance. So one of those two is going to happen. There's two places a stock can go, up or down. Gee, thanks, George. But that's exactly what AXP is looking at. It's had a nice little run. It's still within its channel. And unless it breaks its support, I see it no reason to go down to 55. It probably hold the support and run up in its trading channel. Okay, let's look at eBay. I'm going to keep this webinar under 1 hour, by the way. We're going to have a shorter one. We're posting this one online. It's a free-for-all. It's our 25 predictions edition. And there's no individual trade, so there's going to be pretty much nothing to break down other than looking at things from a grand scale. All right, a lot of times you have this magnifying glass and we're zoning in for entries and trying to make profits. But what ends up happening is we never look at the big picture. All right, trying to fit that puzzle into the mass. The one small piece you try to fit in the puzzle, well, sometimes we focus too much on that and we don't really look at what the puzzle says or what the picture on the puzzle is. And that's what we're doing today. All right, so for eBay, 2014, much the same as 2013. And you can see here in 2013, actually, it was a much tighter trading range. In 2014, it loosened up a little bit vertically, or sorry, horizontally rather. The coils stretched out a bit. It's like taking a spring on both ends and stretching it. I don't know if you guys have ever done that. Taking a string and then stretching it, spring to look something like this. That's what's happening on eBay, but it's still in a trading range. Now, the notable thing to do or to notice in 2013, it went sideways because it had a really good run through 2012. So 2012 was a rally. 2014 was a consolidation. All right, 2013 was a consolidation rather. 2014, the consolidation also continued. So a 1-year run had a 2-year consolidation. The difference this time is that it's now pivoted off this support. It's bounced off it. Okay, bounce and rally, bounce and rally, bounce and rally. So the question for eBay is going to be the following. All right, the question for eBay is the following. Is this support going to come into play one more time where it lines up with the horizontal range and take us finally above this 59 level and take us for a renewed rally? Or will it continue in the trading range? And if it does, boy, I got to tell you, I love eBay's trading range. It's so accurate, so predictable, and it's made us a lot of good coin over 2014. So we'd be happy to see that. Just keep in mind that at a certain point, the continuation of this trading range means that this trend line is going to be breached. All right, that's what that's going to mean on eBay. So that's the alternatives, or really the possibilities for 2015. Do we continue in a trading range? Are we going to finally get the support line to take us higher, or will it break? Those are the only alternatives here. That's how we're looking at eBay. So we're neutral to slightly bullish, but if it breaks that trend line, I'll be happy buying puts. All right, Google. Here's Google. It's had a pretty interesting 2014, hasn't it? So where did the year start? Right in here, it started off with some promise. It dropped a bit. People panicked. The support line picked it up. And then we got a triangle happening. This triangle broke out. We did a roll reversal, and now we're riding this $500 level. Now, I don't know if any of you remember, but at some point in Market Analysis Live, I drew this line, and I said, you know what, Google is going back down to $485. And you guys thought I was nuts. And I also remember saying that at some point 400 might come into the deck of cards as well from this first trend line. Remember 1, 2, 3, the ascending trend line rule. It's not quite there, but I'll tell you guys this much. All right, 445 on Google or even 466 makes a lot of sense as a support. All right, first of all, it's a 38% fib retracement. Second of all, it's a nice 481 horizontal level from these previous tops and cluster of price action. It would make sense for a bounce here. Okay, that's what we see happening in 2015, and it'll run its course here in December. So 2015 in Google is going to be the year of bottoming out. Whether it's a cup and handle, whether you have a rounding bottom, triple bottom, whatever it is, we're going to see some stabilization before we continue up in 2016. Okay, so Google, get ready for some rockiness. Home Depot. What's Home Depot looking like? Well, Home Depot had a massive run up in 2012 and 2013 and a pretty sideways 2014 for the first half, and then it rocketed to new highs. Okay, so Home Depot's on a tear. We've admittedly missed this trade, and we're just letting it go. All right, we're going to let it go until we get a retracement. If we catch it back at support, we get some call options. That's what we're waiting for. So this is a trade that got away from us. It happens. All right. The good news is it's got away, but volume hasn't really been looking that great in especially the last couple weeks here. While it was going up, volume was weak. It's finally returned, and we got to see the first few weeks what it looks like in 2015. All right, volume's low. This might be the time for a retracement on the way down. Okay, let's look at Netflix. Boy, has Netflix had a rocky year. Jeez Louise. All right, Netflix is very volatile, first of all. Because of the nature of its business, it's a volatile stock. In 2011, it started at a certain price, around 180, rocketed up to about $300, and then dropped to end the year at $63. That was 2011. It was one hell of a year. 2012, flat. All right, it made a little run. The dead cat bounce, as they call right here. Why? Because even a dead cat will bounce. Had a dead cat bounce, drop back, finish flat. 2013 had a fantastic year for Netflix. Blockbuster. Took it to a new high. 2014 was the year of volatility. All right, look where it opened. It opened at 381. 1 second, or did it? January 380. All right, rocketed to 450, down to 300, back up to 475, and now down to 340. All right, this is massive volatility, a lot of fluctuation in 2015, guys. Honestly, I wish I could say any different, but I could expect the same. All right, Netflix, we can expect the same. As it decides what it's going to do, it could stay in this massive, huge area. The good news is, on a daily chart, when this guy starts bottoming out, look at this, bottomed out here on an inverse head and shoulders, or a 1, 2, 3 triple bottom, whatever you want to call it. It broke out here on high volume. Huge trading opportunity. Guess what's happening right now? We're in the midst of another $298 to $300 support level bounce. The same thing that took place in May of 2014. So we could be up for a $70 rally from this point. Guess how much money that is in options? Quite a bit. So this is another exciting opportunity. Netflix and Amazon are exciting opportunities for 2015 so far. Starbucks. Let's go on the weekly. What has the Starbucks done in the last couple of years on a weekly chart? 09, 10, 11 were all rally years. 12, we had a nice little rally in the first quarter, and then it sunk right back to support and wiped out the whole year. Okay, well, the year was flat for 2012. And then it just took a little bit of rally at one point. 2013, bullish year. 2014, consolidation. Okay, so I don't know if you see a pattern here, but look, a year up, consolidation. A year up, consolidation. What comes next? Potentially a year up, right? And that's the question. So for 2015, on Starbucks, we're bullish. We're looking at this. We're liking it. We're also seeing 1, 2, 3, 4. Actually, based on the Elliott wave, that can't be counted that way. Why? Because the second wave can't be the shortest. But I mean, if that's the case, let's say 1, 2, 3, 4, maybe we'll go up for another wave, number 5 for a rally. And that looks promising as well. So we're bullish on Starbucks. It's broken out of this triangle. It's retraced. It's looking like it wants to go bullish. We'll give it a week or two to see how volume reacts. And if it spikes and price holds this support line, which was a previous resistance of this triangle, we're going long on Starbucks. We're riding up to $100. Easy, up to $100. Okay, that's Starbucks for 2015. SanDisk. Let's go weekly on SanDisk here. I apologize if you hear some background noise. SanDisk, nice little bounce off of support. 79.80 was our Fibonacci support, and we called that all the way. Bounced up, and 2014's been a bullish year with some volatility, mind you, but skyrocketed, dropped, skyrocketed once again. It looks a little bit like S&P 500 actually on SanDisk, but it's been a bullish year. For the rest of, play with your eyes here. For 2015, this is 2014 by the way, because I froze the screen so I could show you. This is not extending, but this is 2014, this is 2015 here. Sorry, 2015. This is the year that we're looking at, that we're projecting into. we can see the price getting trapped here in an ascending triangle in 2015. All right, so 2015 might be an ascending triangle on a broad scale for SanDisk. All right, that's what we realistically see it as happening. It might break out as well and continue bullish, but it needs a little bit more time based on the weekly chart to reset. Okay, and that might take it up into 2015, ascending triangle with this trend line. Very likely and very realistic. Looking at Yahoo, how has Yahoo done? Well, 2013 rally, 2014 we had sideways for 3/4 of the year, then it ended the year on a tear, mainly based on Alibaba. A lot of this was Alibaba growth and excitement. 2015, we see some retracement that looks something similar to this or a flag pattern. All right, we had a huge trade off these flag breakouts that made us a lot of money. So we're going to see a flag probably take place sometime into 2015, and then this first Q1 or Q2, it's going to pop that flag and go bullish. And we're going to be on board. So that's how we see Yahoo. So we have a lot of good stocks, a lot of opportunity in Netflix. We see opportunity in Apple. We see opportunity in Amazon, Yahoo. And the only question is, how will the overall markets react based on interest rate rises in 2015? That's the uncertainty. That and unemployment. Okay, will unemployment continue? Will salary, wages continue to be at record lows in comparison to corporate profitability? All right, that's the question. How long and how low will oil continue to plummet to? All right, what will the politics say to that? How will Europe handle some of its new debt crises? Those are the questions that can't be factored into this yet. I don't have answers for you. Okay, from a sector analysis, we're going to do this and end the night. From a sector analysis standpoint for this 1 year that we've had, all right, here are the absolute best performing sectors. Semiconductors and semiconductor equipment, 27% return. Transportation, 23% return. All right, obviously transportation, guys, if you think about this, costs are decreasing because of oil. So transportation has done well. Healthcare and equipment has done well as well. Utilities, food and staples. And then we get down all the way into here where now we get the worst performing sectors for 1 year, and that's energy. Energy's been absolutely hammered, 8% return the last couple months. It's done brutal. Automobiles and components, surprisingly lower. All right, telecommunications, capital goods, materials, insurance, retailing, all higher. So we only have 2 industries that had a negative return in 2014. And that should tell you something. Markets might be overstretched. They might be a little bit exerted. In terms of all sectors, up until December 24th through 1 year of data, again, there's the 2 that were losers. Everything else had positive rates and returns. Where's the financials? That's what I'm trying to find to show you how financials have done. Food and beverage, diversified financials. There you go. Financials, 15%. Semiconductors, biggest winners. Real estate as well has done well because of low interest rate environments. The game's going to change in 2015. If interest rates go up. Plus, all these sectors have done really well. And at some point, no matter how long you're at the casino, no matter how good of a stretch you're on, if you have a horseshoe taped to you and you're winning thousands of dollars a minute, at some point, you're going to have to cash in those chips and go home and get some rest. All right, and that's the year of the market, 2015. Cashing in its chips is what could potentially take place. That's what we're worried about. For 5 years, all sectors, I'll show you what they look like. Only energy is negative on, 5 years, not even energy. Everything's been positive. Rate of return in all sectors for 5 years, not one sector is negative. Not one single sector. The worst performing is 25% return in telecom. Best performing is media. Financials, where are they? Diversified financials are probably up there towards the best. Okay, not the best, but 40% return. Not bad either in 5 years. Okay, that's a sector breakdown. Other thing I wanted to show you quickly was all of the different ETFs. The XLE ETF here is, I believe, the energy one, which has done really bad. Energy Select, exactly. XLE has done bad recently. We've also done bad on oil, obviously, but all other sectors have done pretty well in 2014. So let me zoom out and show you what I mean. 2014, all sectors have done well except oil and energy. But they're all towards a resistance cumulatively. Okay, we've had some flat periods through 2011 and 12. 2013 was a run, 2014 was a run, and now 2015 we think we're going to see some volatility and choppiness, a slowdown in the trend. Okay, so guys, what have we done so far this session? We've looked at our 2014 results as traders. We've looked at our 2014 predictions and rated ourselves on them. We've made some 2015 forecasts and predictions as well that we're going to rate ourselves on in 12 months. We've looked at individual stocks and how they're going to do in 2015. We've looked at individual sectors and how they've performed. Talked about economics, talked about oil, gold, US dollar, equity markets. What else to talk about? We've covered pretty much the entire economy. So how do you guys feel? We talked about unemployment, yield rates. You have a strong basis of expectation in 2015. I do remind you, this is all for research and educational purposes. Anything can happen, and I'm going to give you a quote on that end. Okay, make a plan so you know what's. I know I'm not typing very clearly. You know what? Here, I'll give you my quote that I've been using. I don't know who said it, so I can't attribute it to anyone else but myself. As far as I remember, I've been saying this quote to a lot of people. Okay, here's my quote of the day. Make a plan so you know what's not going to happen. All right? George at TPA. There we go. There's my quote. This is going to be my contribution to history. Hopefully it's a bigger contribution than that. But in all honesty, I do believe this. Make a plan so you know what's not going to happen. At the end of the day, what you have to plan is to educate yourself as a trader, to identify opportunity, and based on that opportunity to create a trade plan to capture the opportunity. All right? There's absolutely nothing worse in trading than knowing there's opportunity and not being able to capture it. All right? There's nothing worse than saying gold went up in 2015 and I knew I was going to do it, but it didn't make money. You're better off not even wasting time analyzing data if you can't come up with a plan. The plan is how you do stuff, and the plan gets down to your nitty-gritty. All right, guys? Make a trading plan, follow it, test it, revise it if you need to, and we're here to help you with that process. Right? We've done that process hundreds of times for my personal accounts and for others. So we're here to do for you guys, to help you with that process. Trading at the end of the day is not the same for everyone. When you go out there and you hear somebody saying, I'll teach you my trading strategy that's generated X amount of return, don't buy into that kind of stuff. Here's why. That trading strategy works for that person for a specific reason. And you don't know the reason, but it works for a specific reason. You got to find your trading strategy that works with your strengths. All right? And it also is cognizant and aware of your weaknesses. That's what the trading plan does. Okay? You got to lay it out. But again, here's our predictions. Here's what we think is going to happen in 2015. Make a plan so you know it's not going to happen. It's going to be an interesting year. I thank you guys for staying by our side. You guys are a huge part of Market Analysis Live and what it does. All right, and I want to wish you all a happy new year. Go out there, party like it's 1999, even though it's really 2014. And I can't believe it's 2015 already. It's insane how quickly time flies. But there it is. You guys have a happy new year. I wish you happy celebration. Make it memorable. But at the same time, I hope you're safe, sound, and stay in one shape because we got a lot of business to do in 2015. I got a good feeling 2015 is going to be our year. It's going to be TRADEPRO Academy's year, and it's going to be your year because you're part of it as well. Okay, so I'm happy. I'm excited. There's a lot of work to do, a lot of opportunity, a lot of money we can make together, and a lot of changes coming your way. Okay, guys, do you have any questions so far or comments? I would urge you in the next couple of days while you're not trading, we gave you the last week off, but for this week coming up to put together a trading plan. Maybe when you're going to enter, when you're going to exit, how much percent you're going to risk per trade, what you'll trade, what securities, how long you'll trade them for, when will you revise your plan, when will you know it's time to give up. And by give up, I mean give up on the current strategy and revise it, make changes. Okay, think about that stuff. Let's put this stuff to motion, because I'll tell you something, trading in a career is not about education. All right, if you ever see a company or a product that offers you education, all right, if you want to buy other education, not from TradePro Academy, by all means, go ahead. Get education from whatever makes sense to you. However, if they only offer education, that's a one-way road, okay? There's no such thing as a PhD in trading. You can have all the knowledge, but it's an applied art, okay, guys? It's a skill. Work on your skill. Don't work on the education for too long. Start doing it and applying it. It's an application-based career. That's all I got to tell you. I wish you all the very best. I hope you had a fantastic 2014. If you have any comments, concerns, we're here for you guys. Honestly, I'm super happy and very thankful for each and every one of you guys and your contributions into what has come or what has become today from TradePro Academy. All right, guys, have a fantastic evening. Happy 2015. Let's take this year out on a bang, and I'll see you next year. Hate to be one of those guys. I'll see you in a year. But our next webinar is Sunday, January the 4th at 8 p.m. I'll see you all there. This will be archived by tomorrow around 2 to 3 p.m. Take care to all. Have a fantastic evening.